What's up, everybody? We're just about to be getting started in a minute too, so let some of our speakers get in here. I see we got Brad up here, and we got Wolf coming in here. This is the second Spaces in this series, but pretty much the crew of four we have today is really going to be the core for this Spaces series going forward. We're looking to add some more people kind of to give more fundamental theses and deep dives into stocks over the next couple weeks or so. But this is definitely going to be the core people on this space going forward. And, the real purpose of this space, as we talked about last time, was to make more spaces for long-term investors. Trading is great. You can get a lot of it. You can get a lot out of it. And, doing these spaces for it is super informative, really well received. But there's a huge side to, long-term investing, the other side of the coin that doesn't get as much coverage on FinTwit. And we want to make sure there's a spaces each and every week for that purpose. So right now we're doing deep dives into individual stocks with a purpose of trying to be educational, trying to ask some other questions along the way. We're going to change that up at some point. We're probably going to go another 2-3 weeks on this format, and we'll see what else. But no matter what, noon on Thursdays with this crew of four people as the core, we're going to get some really cool people to come in and join us. It's always going to be about long-term investing. So if you're not following them already, make sure you're checking them out. You will want to follow them a bunch going forward, the four people we have up here right now. Actually, 5, including the Rippers account. With that, let's hop right into the long-term investing theme here. I do got a couple questions planned. We'll throw those at you guys in the second half of this space. Probably going to run for about an hour on here. But I would love to throw it over to Brad to start out with the SoFi deep dive.
Yeah, let's do it. So exciting week for SoFi. We'll talk a lot about the banking charter, but should probably talk about the business a little bit first. So if you guys watch TV, I'm sure you've seen one of their commercials. They're trying to, and I quote, get your money right, borrow, save, invest, spend. They're really trying to be the one-stop shop, the super app for financial technology and for consumer-facing financial technology. So they started with a student loan product, and then around 2018, they aggressively pivoted to building out the remaining of these financial products in just a couple of years. That's when Anthony Noto took over, and I'll talk about that also a little bit more later, but more on the product suite for now. So the products are really designed to be better together. So a couple examples: you get Bitcoin rewards for spending and making a timely payment on a personal loan with SoFi. They have a loan and money bundle that they just started offering for lower rates on personal loans if you pay it off with direct deposits. So better together is a real key for their consumer facing segment. And the company is really determined to be at the consumer side for every single major financial decision. What they think and what they've seen so far is that doing so builds loyalty and makes people, it builds brand loyalty so that when a customer is ready for another financial decision, they just intuitively and innately think SoFi instead of having to go somewhere else. And that separation, that gap when financial institutions don't have a product that a consumer wants has really been shown to hurt consumer loyalty and stickiness and retention. So you've seen banks doing things like offering auto refis, which are becoming more profitable with the help of some other companies that I'm not going to get into today. But they're doing it really for convenience factors because they know that they need to be offering every single product that their members want if they want the highest chance of retaining that member going forward. But being there for every single major financial decision has two really, really positive benefits for the company. So one, it's a 50% compounder right now, very early on in the S curve and the growth curve. And it's already at positive EBITDA margins. It already has a contribution margin over 30%, and it's already been net income break even. It wasn't last quarter, but it's not losing very much money from a net income perspective either, despite being so early on, and despite a lot of its products being less than a year or two old. The other really strong benefit is, and this is turning into a cliche on Twitter, but it's turning into a cliche for a very good reason, is it coincides with the large LTV, consumer lifetime value boost, with very little additional CAC, so consumer acquisition costs. So just an example from their slide deck, one money product that SoFi sells to a customer gives you $250 with a 34% contribution margin and a $40 CAC, customer acquisition cost. Now, if you cross-sell that with one loan product, one of their many loan products, the mean advantage, the incremental advantage is now doing $2,300 in revenue with a contribution margin of 80% and the exact same CAC. So the LTV advantage that SoFi enjoys is really not unique. Banks that that offer kind of more of a legacy, more traditional version of a full product suite have this exact same cross-selling ability. They have this exact same LTV advantage over point solutions within digital banking and banking overall. But what this also means is that because SoFi is not a bank, it doesn't have thousands of branches and tens of thousands of employees for these larger banks across the country. So this really fosters a digitally powered consumer acquisition cost over banks, while they also have that LTV edge that banks are also enjoying by offering all of these products. So consumer acquisition cost for a bank can push $1,000. For SoFi, it's around $50 to $100. So they really that really gives them the green light to lean in heavily on marketing, which is why we all have get your money right stuck in our heads, and which is why they shelled out tens of millions of dollars for the naming rights on SoFi Stadium, and is why they spent so much money on this TikTok Money Moves dance campaign that got them 5 billion hits and doubled their unaided brand awareness. This is really why they have the permission, the green light, the evidence, the justification to really lean heavily into market share, because the LTV is so compelling, because they have so many opportunities to cross-sell products, and they have really high NPS scores when you look across the industry as well. So all of this is fostering pretty notable success. Last quarter, double-digit top-line beat with some pretty darn tough comps. Product and member growth all exceeded expectations. They posted positive 10 million in EBITDA. They were expected to lose around 2 million in EBITDA. And really, the thing that I want to highlight is their incremental EBITDA margin. So their EBITDA margin on brand new revenue is now north of 40%, 40% for 2021. When you compare that with the 3% EBITDA margin they're currently at, there's a lot of room for expansion. And that 40% is also showing signs of really recent progress, because just one quarter before that, it was in the 30% range. So that brand new revenue on the most recent quarter was even more profitable than that 40% benchmark that they gave out. Also, they've I'm about to talk for 30 minutes, so I'm gonna move on to another piece. But really, the challenge here, despite all of this, and me liking SoFi so much as a standalone B2C company, is that there are so many firms trying to create this one-stop shop and trying to really realize the exact same advantages that SoFi are. I mean, there's some of SoFi's clients from the B2B perspective, which I'll get into later. You think of Dave.com and Moneyline and Revolut and PayPal and Square with their very deep pockets, and they really are all going after this core business. So that brings me into two key differentiators, that one of them is very recent and one of them is not so recent, that really kind of makes SoFi stand out, in my opinion, in a sea of competition, in a sea of really commoditized competition, because there's not very many things you can compete on in the digital banking sector besides automation and better rates and a slick UI. But one of the key pieces of SoFi, and why I like it so much, is that it has a B2B, a business-to-business branch through the acquisition of a company called Galileo. So to me, this was a game changer. I'm not super interested in traditionally consumer-facing banking companies, but this really made it stand out, and I'll try to explain why. So Galileo provides application programming interfaces. So just think of these as products that enable core software functionality for payment processing in the world of fintech. So it calls behemoths and titans like Chime and Robinhood and again, Dave.com, Moneyline, Revolut, that's where those examples came from, and many, many more, all customers. So it collects transactional revenue, volume-based revenue from all these companies. So really, while fintech and digital banking is commoditized, the industry as a whole is growing rapidly, and this really ensures that SoFi is getting a piece in that rapid growth, regardless of the fact of if it finds B2C success, which is fabulous right now and continues to be very good. But for all the reasons that I mentioned, there's really no guarantee that any of these platforms, no matter how big their membership bases are going to continue to keep attracting talent, or to continue to keep attracting demand. It could be a race to the bottom in terms of offering better rates or in terms of offering better rewards. But this B2B branch really allows SoFi to separate itself from that race to the bottom and really to profit in a very unit economically favorable way within this B2B branch. But going back to B2C, and I'll also talk about Galileo here a little bit, and why and what happened this week and why that the stock is doing so well, even though it's still down 20% month to date. So not all that well, but I own it and I like it, so I won't rip on it too much. But SoFi has now been approved or conditionally approved by the OCC for its banking charter. So it was going after this for over a year. It got other conditional approvals that were less finalized, that had more vague, I guess, contingencies. Sorry, I was looking for the word. Than this one, and it didn't really give a timeline on when this was going to get closed. Now we know it's this has been approved by the OCC and the Federal Reserve, and it should be signed and good to go by February with all the benefits that coincide, which I will explain right now. So with this banking charter, SoFi no longer needs to finance its loans through expensive warehouse facilities. So I tweeted about this today, but I'll go into it a little bit more. So it can now use its own deposits from these money products in order to finance the consumer and student loans that it's issuing. And according to CFO Chris LaPlante, this will have a 200 basis points, so 2% benefit, so reduction to their cost of capital, which makes this lending business more profitable immediately. So also what this does is because SoFi wasn't a bank didn't have a bank charter, it was regulated independently by 50 different sets of state level rules in terms of loan origination volume maximums. So it was really handcuffed in how many mortgages it could actually issue in certain states with this banking charter, and now only being regulated by the FDIC, the Fed, and the OCC. That those handcuffs go away, and it can now loan. It's SoFi's prerogative to issue as many mortgage loans as it wants to. Hopefully, it will continue to be responsible, like I think it will be in that endeavor. But yeah, the handcuffs are off, and it can really sink its teeth into loan growth there now. Also, they'll be able to hold any of the loans that they want to on their balance sheet. This leads to more consistent and favorable net interest income for the pieces of their loan book that they're most confident in retaining. And they also have the freedom to provide an interest rate or checking and savings rate, or I'm sorry, an interest rate on checkings and savings accounts that it determines instead of being assigned by the sweep partner that it was using. So going back to fintech being very commoditized, consumer-facing financial technology being very commoditized, this really allows SoFi, again, leaning into that LTV advantage that it has over a lot of these competitors, to offer things like really favorable interest rates on savings accounts that other competitors can't do so profitably. So differentiation is tough to come by in fintech, and that's really the core way that you differentiate yourself, and this free SoFi to do so more aggressively. Now, speaking of sweep partners and bank sponsors, SoFi is now going to be able to do all of that itself, so save on third-party costs there. But the interesting thing is Robinhood and these other large Galileo customers, they also need sweep partners and they also need bank sponsors. So not only can SoFi cross-sell within the consumer-facing segment of its business, but it can now cross-sell within the business-facing operations of its business. That sentence was pretty lame, but I'm gonna keep going. So they can now cross-sell these APIs, these payment processing APIs that they're selling with these services in order to, again, create more LTV per enterprise partner without really spending a whole lot more. So exciting times for SoFi. I'm going to go into leadership really quickly, and then I'm going to go into what's next, and then pass it on to Stock Talk Weekly because I'm excited to hear what he has to share. But Anthony Noto is the CEO of the company. He is not a founder, and I'm kind of grateful that the founder is not involved anymore. It was Mike Cagney, so he was ousted in 2018 for a culture that was described as fraternity-like, promoting sexual harassment, and really, I mean, Activision Blizzard probably was a pretty good comp for SoFi's culture before Anthony Noto took over. But enter Anthony, a former Army captain, a former executive at Twitter, and a former executive at the NFL, the former head of TMT at Goldman. And he really righted the ship culturally. That was his first North Star to fix what was really a broken reputation at that point in time. But it's not just his resume that I respect so much. It was the operational pivot that he really orchestrated that I deeply identified with. So he turned the company away from their core student loan product that was emphasizing volume at all costs and was aggressively burning through cash, not really caring about net income or EBITDA or anything like that, just focused solely on the top line. He brought that segment to profitable unit economics and then used that cash to embark, and some other cash from capital markets, to embark on building the super app that they now have today. So he saw and then he also saw the value in integrating Galileo and creating an inherent B2C edge in a space where competition is fierce. So he moved, and then also what he did, which I respected, is he moved Galileo's entire product suite from on-prem to the cloud to speed innovation and iterations, as well as all these integrations, a lot of Shin's words, but with these cloud-native fintech titans, so that he could really built a more collaborative company, so that Galileo was able to accelerate its growth by not being seen as such a competitor, but as more of an augmenter for a lot of these companies, which is why we've seen things like 13 customer ads in 1 quarter for Galileo when they have 35 customers overall. So just really impressive growth there. But what's next for the company? So for the consumer facing, buy now, pay later, probably my least favorite part of financial technology, but buy now, pay later is now coming to Latin America thanks to Galileo's extensive presence there. It serves the 4 largest neobanks in Mexico. One of the things that I appreciate about this BNPL endeavor is that they're starting very small and they're not making some mammoth acquisition in order to enter the space, while multiples were peaking and mania was peaking. I won't name the company that I'm talking about, but I really appreciate this BNPL path more, just because I'm a little less optimistic on where BNPL is going to go. So spending less is favorable to me, in my opinion. And maybe I'm wrong, and I'd be happy to be wrong. And if I'm wrong, this will work really well. And for a company like PayPal that I have a new position in, that'll work for them too. So we shall see. But they're introducing a credit cards reward program, credit check services. That they're really doing everything. Basically, that their product suite now is a customer will come to them and say, well, I wanted this and you didn't have it, and essentially they fill those gaps. So their product suite isn't being expanded upon with large kind of revolutions like an investment product or a crypto product anymore, but more subtle things like that credit card rewards program, just to really boost value wherever they can. But moving on, SoFi Invest launched in Hong Kong with the intention to use this launch to, and I quote, land and expand throughout Asia with invest in other products. So really exciting new geography for them. They're also really expanding aggressively into Latin America, using Galileo as kind of the foothold into that geography. A quote from Anthony Noto: in 3 to 5 years, we hope to be on 4 different continents, including North America. And then for Galileo, they are enthusiastically trying to broaden the API functions that Galileo can really provide to their their enterprise partners, to go into things for other pieces of the value chain in terms of software provisions. So kind of think of Plaid and what they're doing, and it kind of seems like Galileo is trying to maybe overlap a little bit more with their product suite and what they're trying to do, not getting outside of just core payment processing, and trying to build functionality and utility in other pieces of investing or borrowing or saving or spending. So yeah, that's really what I have on SoFi for you guys today. Enterprise value, I think, is sitting around $10 billion. And with this bank charter, they go from doing a little less than 250 million in EBITDA this year to almost 500 million in EBITDA this year. I think it's going to be a little less than that, just because we're now a few months delayed. So the benefits are going to start in March instead of January. But still, you can kind of do the math and see that as they inflect a net income positive, and as they really build that EBITDA base, the growth is there, and the multiple is starting to get a little bit more compelling. So I've been pretty aggressively building out my position, and should end with the fact that or end with just the reality that I said all these nice things about SoFi, and just know that I'm inherently biased because I own a lot of SoFi. So please do some work and some research and some digging yourself to see if you truly agree with what I'm saying. And if you don't, that's entirely fine and entirely your prerogative and what makes a market. And thanks for listening to my spiel on SoFi. And I'll pass it over to the next speaker.
Definitely, I'll come actually back to you with a quick question for that. But I just want to get at it. The real point of this isn't, oh, okay, here's a long-term thesis on the stock, I'm going to go and hit buy. It's for you to start doing your research. It's hearing what people who are doing their own research are actually looking at, the type of terms, the type of numbers he's looking at. And when Brad pulls up stock, he's also talking about their competitors, the industry, everything like that. So that's where my question is going to lead here. it's conventional wisdom that you got to know what your company's doing if you're picking stocks and you're becoming a long-term investor in that. But how important is it to you to really kind of become an expert in the sector that your stock plays in? And then if it is super important to you, or if that is something, just any tips for taking like a passion or an interest of yours to that next level? Is it really just kind of searching out Google and YouTube videos and kind of just taking that first step, or is there any pieces of advice or anything you kind of have in there?
Sure, a couple pieces there. So if I miss any pieces of your question, please just remind me, and I'll try to answer it. But I'm really not. I don't like require myself or force myself to have to learn the ins and outs of every single competitor and every single substitute in the industry. But what I do force myself to do is learn the ins and outs and kind of the plumbing of how the industry actually works. So right now, I'm writing a deep dive on Upstart, and I've spent the last few weeks talking to people in the industry just to really to iron down how the securitization process works and how Upstart plays a role in that securitization process. And it's complicated. Last month it was GoodRx and figuring out how the pharmacy supply chain works. So I require that I understand the industries that I'm investing in and out, and that by doing so, a byproduct of that is often that the largest competitors I often read a lot about. So I know a pretty good deal about them as well. But I mean, you could probably name 10 mini or small neobanks right now that I've never heard of, and that doesn't really keep me up at night as long as I have a really good understanding of how the industry actually works and what kind of exogenous factors can impact the industry in terms of tailwinds or headwinds. That's really where I'm focused. And then again, byproduct of that is the largest companies I generally have to read a lot about to know the industry well. So I generally do read a lot about them.
Awesome, dude. Appreciate that. Thank you. We'll keep it moving over to Stock Talk. We'll come back for some more long-term investing questions. Big shout out to you, Brad. Like I said at the start of this, the space is really, this is going to be the core for this long-term investing space going forward. We're going to be bringing in some really awesome people going forward, some great additions, changing up the format, everything. But what's not going to change is the four of us up here, the five of us actually are the counts, but I'm Stock Market News if you didn't know, Evan. That's my account. But the four of us up here, and the long-term investing theme Thursday at noon. So if you're a long-term investor, we're always trying to change stuff up. We're trying to make it better. We're trying to improve. We're trying to give you guys such great information because there's a bunch of spaces about trading on Twitter, and that's fantastic. But we feel that there just wasn't enough for long-term investing. So we really want to drive value to all you guys and girls, and we're excited to do that. We think it's a really valuable part. Really what the initial point of me going down the spiel was, make sure you're following all the speakers that we have up here. They all have fantastic information. Myself, Brad, are definitely much more long-term investors. Stock Talk, switches between long-term investing and trading. And Wolf does that the same as well. I think he's been getting much more into the trading. We'll let him speak for himself on that later. But all these people have a great mix, but they're all definitely long-term investors, and you'll get a lot of great stuff from following each and every single one of them. So check them out. Give them a follow, and I'll cut off this little intermission here and throw it over to you, Stock Talk, for your deep dive. Also, if you want to answer that question that I threw out Brad about competitors and knowing the industry and being an expert, you can answer it, or you can just jump right into your deep dive. He did do a good job.
Deep dive on what?
Any stock sector. I know we talked about lithium and everything like that. I would love to. I know everyone likes to come out and throw jabs for Planet and RDW in the space sector. I bought in at 5, so I'm chilling. I use your recommendation of the stock to add it to my watch list, do my research, and buy when it got to a good point. But yeah, a deep dive into any stock, any sector, anything you're long-term bullish on.
What's something I can talk about? I mean, I was going to talk about SoFi, but I mean, Brad covered that very well, and pretty much covered, anything I was going to say on that. So I don't want to be repetitive. I guess since we covered lithium last time, I think a space that has been sold off a bit relatively recently that I'm very bullish on going forward, and that I want to build more exposure in as well is probably the online betting and gambling space. I know today there's a bounce in some of those names. I know that Genius got a $15 price target from Credit Suisse, and so maybe we can touch base on Genius Sports and some of those other online gaming and gambling names that I'm interested in. For those who are not familiar with the sector, just to kind of start it off with a metric. So going back to 2017, over 80% of all bets placed nationally, in terms of sports bets, were placed at physical sports books. So, like physical casino locations around the country. That was just in 2017. And now, 4 or 5 years later, that number's flipped on its head, and we have 80% of sports bets nationally being placed digitally. And that's about the quickest turnover in an alternative or convenience-based product that I've seen in any sector ever, as far as long as I've been looking at businesses. To see that kind of switch in preference and change in preference in such a short period of time, I think is really convincing for the long-term trends of the space overall. But when you look at the prospects and the way these companies are valued, at least the ones that have coverage on the street, that's mostly DraftKings, Penn National, Caesar, MGM. These are the stocks that the street has thorough coverage on. And if you look at their valuation models, I mean, they are not anticipating an exponential growth in net gaming revenue nationally. And I think that's really the crux of why a lot of these companies need to be re-rated in the long term, because I don't see a scenario where this industry doesn't grow exponentially. You're talking about a massive roadmap for legalization, which we saw, several state-by-state legalizations over the course of the last 2 years. I expect that trend to continue. I think we'll get very close to, I wouldn't say full federal legalization, but, rampant federal legalization, 35 plus states within the next 5 years is my view on it. And I feel that way because I don't feel like there's the same stigma around legalizing sports gambling. And this is something I've mentioned before on other spaces as well. I don't feel like there's the same stigma around legalizing sports gambling as there is around legalizing marijuana on a state-by-state basis, because I think there's a lot more political hesitancy, if you will, in certain states around legalizing marijuana. And so, I don't think that same hesitancy is going to carry over to the sports gambling space. And knowing that we see this trend where we flip from 80% physical betting to 80% digital betting, that trend probably actually continues to increase on the digital side. And I wouldn't be surprised for us to see 90% plus digital sports betting. And it really comes down to just pure consumer convenience. And it just doesn't make sense. And we've seen this same trend in so many other industries already in the last decade, including streaming, which is now, or I anticipate in the next several years will really just overtake the entire theater and in-person movie business. Obviously shopping, e-commerce, the emergence of e-commerce, right? And these trends are very hard to resist because of the cost efficiency, but also just pure consumer convenience that allows people to make these preferences. And so, I think this is going to be a massive market nationally. I think net gaming revenue will probably increase triple digits year over year going into 2023. The NFL in September announced that it was their all-time month for sports betting. In November, they announced that they beat the September numbers. So, by the end of this year, barring something dramatic happening, which I don't see because we have the Super Bowl coming up and, sports betting tends to go through the roof headed into the Super Bowl. So by the end of this season, the NFL will likely announce that they had an all-time season for sports betting and net gaming revenue. And I think that will really propel the street to kind of take another look at these names and reconsider the multiples that they're trading at. When you look at Credit Suisse's coverage of Genius Sports, which is an exposure I love, I mean, stock ran from 10 to 25 and then traded all the way down to 7. So obviously it's been a bumpy and volatile ride, but I actually still really like the stock. If you look at Credit Suisse's report, give me 1 second, let me pull it up. Yeah, so I mean, they started coverage yesterday at Outperform with a $15 price target, which implies over 100% upside, with it trading at 7 now. It was trading at I think 620 when they dropped the report, but they're projecting a 5x 2024 revenue estimate, which is a very reasonable valuation versus peers, right? Like when you look at other peers in the space, many are trading at a 10, 12, 15, 20x multiples even. And so, them projecting 630 mils in rev in 2024, I think is relatively reasonable. But I think the best thing in this report, which is something that I talked about, I don't want to say like I was before Credit Suisse to talk about this, because I think it's a relatively obvious point. But one thing they mentioned that I've kind of was always behind my thesis for Genius was the flywheel effect of the fact that Genius has this exclusive NFL contract for 6 years, which means that they are the only official sports data provider of the NFL for the next 6 years. Is there, long-term risk past the 6-year period, under the consideration of if they can get that contract renewal secured? Of course. But within that 6-year frame, which, 6 years is a lot of time, businesses can grow exponentially in 6 years. Within that 6-year frame, you have the biggest sports league in the world in terms of betting, in terms of net gaming revenue, which is the NFL. And you have an exclusive data provider who's getting 2 to 5% off the top of every bet placed using their data nationally. They do not have the same balance sheet weights, if you will, as other players in the space. When you look at individual sports books, you look at RSI, DraftKings, Caesar, MGM, it's a massive customer acquisition war. And I've talked about this in the past as well, about how this space is going to graduate from being, it'll be a customer acquisition war like it has been for the last 2 years, probably for the next 2 to 3 years. And then after that, it's going to evolve into a consolidation war and an acquisition war. And, the proof is in the pudding, really, with the customer acquisition narrative. It's not even something that you really need to look at too analytically. I mean, anyone who's been on a social media app or been watching TV, everyone has seen the ads for these digital sports books, right? They're offering $250, $300, $500 to bet for free just to join their book. And this is because it's not a sticky industry, not yet. Because when you look at the products between these different books, it's not like any of them has a revolutionary product. They're all relatively the same UI, same general software. Like, none of them are just a quote unquote superior digital product. They're all relatively similar. And because of that, because there's that lack of ability for consumers to, have a genuine preference of which book they use. And I'm not saying that no one has a preference. Granted, there's going to be users who are like, oh, I love Barstool, so I'm going to use Penn. And there's going to be users who have been using DraftKings, which is probably the most nationally recognized brand for a while. And they'll continue to. There's naturally those, layover effects. But, when you look at the broader market and you look at new customers that are maybe betting for the first time, or customers who don't have a preference in terms of brand, it's very hard to differentiate the products. And that's what makes it such a customer acquisition war. That's what's driving the CACs of all of these companies. CAC is just customer acquisition cost, for those who don't know. But that's what is driving the CACs of all of these companies so much higher. It's really damaging margins. It's damaging profitability. I mean, you're looking at DraftKings still being EBITDA negative. I don't know if Penn still is. I think they might be slightly EBITDA positive now. But you're looking at most of the players in this space, is my general point, are still EBITDA negative, despite some of them really having considerable scale for companies of their size. And we're also seeing another trend emerge, which is the dominance of regional markets, kind of arbitrarily, kind of almost in a first mover way. Like, you see smaller books like RSI having a huge presence in New Jersey. And then, you see other markets where other smaller books might have a larger presence there. And so it's a really fragmented market. It continues to be a customer acquisition war. I think it will continue to be, as I said, for the next 2 to 3 years. But once that phase is over, it's going to really become, an acquisition war, purely from, one company to another in a consolidative way, because at a certain juncture, it's not going to be worth the dollar input to, continue this customer acquisition race. At a certain juncture, once the market's more fleshed out and we have more legalizations, then these smaller books will become great candidates for acquisition. Many of them already are, in my opinion. Like, I think RSI is already a great candidate for acquisition. And, if it plays out the way I think it will, I think Rush Street will probably be acquired within the next 2 years. But that's all speculation. My point is that, within the next few years, it's going to become very obvious, and I think immediately obvious to these larger sports books, that it is more capital efficient for them to simply purchase the smaller books than it is for them to try to penetrate these new markets by dumping hundreds of millions of dollars into customer acquisition and branding and marketing. Whereas they can just pick up these smaller players, overlay the existing branding, integrate the customer bases, potentially integrate the applications, whatever it takes. But, I see it as a shorter path to aggregating more market share. I think it'll drive the margins of the businesses up. Maybe not in the near term, because there's obviously the weight of acquisition on the balance sheet. Even if they're going for all cash acquisitions, which, again, just speculation, don't even know if they will. But, there's going to be weight on the balance sheet from the acquisitions. But coming out of those acquisitions, you're going to see margins go up for all of these businesses. You're going to see, like I said, net gaming revenue increase exponentially. And so I think it's really a place to be. But I kind of got off topic there. But going back to the flywheel point about Genius, what Credit Suisse sees happening is that, they see this flywheel effect compounding, because not only do they have that 6-year exclusive agreement with the NFL for data provision, but the NFL also requires that every official betting partner. So when you're thinking of all the major sports books, DraftKings, MGM, Caesars, Penn, they're all official partners of the NFL, right? And if you're an official partner of the NFL, you are mandated to use official NFL data. So this is really a point that's been dramatically overlooked, I think, by every analyst that's covering the stock, and also by the broader market, which is that they don't have a choice. If you're an official partner of the NFL, you must use Genius Sports data. So what it's going to wind up being is that with enough penetration, Genius will effectively be in every single sports market that DraftKings, MGM, Caesar, and Penn National are in, including Fanatics, which is also an NFL partner. So basically every single sports book that you can think of that has any kind of brand recognition is an NFL partner. And by virtue of being an NFL partner, they're a Genius Sports partner. And you look at that 2 to 5% clip for every bet placed. You look at the massively lower capital expenditures that Genius has. I mean, they have the ability to drive really high margins in a very short period in the future, because of the fact that they don't have these customer acquisition expenses. They don't really have to spend money penetrating these regional markets. They're kind of just piggybacking the sports books into each of these markets as legalizations come. So, it's kind of I don't want to say a risk-free exposure, but it's a winner agnostic exposure. And it's an exposure that's completely agnostic to all of this customer acquisition expenditure as well. And so it doesn't matter who acquires the most market share. It doesn't even matter which sports books are doing better in which regional markets, because Genius is an official partner of effectively all of them, all of the ones that you can think of, all of the ones that anyone can name off the top of their head. They're all NFL partners. And so that flywheel effect, I think, will really compound value. I think that's why Credit Suisse was so ambitious with this price target. Putting it at 15 with the stock at 6, I think, was bold. I think their 2024 revenue projections at 630 million are very, very reasonable, considering that Genius will probably do about 260 million this year. And those projections are not factoring in the NFL having record net gaming revenue, which, again, that news isn't officially out yet, but I would bet my bottom dollar that at the end of the season, the data will say that it was an all-time year for net gaming revenue for the NFL, just based off the data we saw in September and November alone. And so, if you think about that compounding effect, and then you think about the fact that it's going to drive, their ability to get incremental business year after year after year with additional B2C partners, and then you also think about, the fact that its valuation multiple is way below peers. You also think about the fact that they have a quicker and more effective path to profitability and a high margin business. And you also have to think about the fact that they are one of the only alternative exposures. Them and Sports Radar are one of the only alternative exposures, right? Most industries, I talk about electric vehicles a lot, and I kind of discuss how you can go with the OEMs, you can go with the battery manufacturers, you can go with the rare metals miners. Usually there's 3, 4, 5 different exposures to a trend or an industry that you can play. But as far as the public markets go and as far as sports betting goes, you're either going with a legacy book that has started a digital arm like MGM or Caesars, or you're going with a new age digital sports book like DraftKings or Penn, or you're going with a data provider like Genius and Sports Radar. So you're either throwing yourself into this customer acquisition war, a very uncertain, developing, competitive, emerging industry where margins are bad and it's rough riding, or you're going with the winner agnostic data providers who have exclusive contracts and take a cut off the top of everyone's revenue. So, I think they're the best exposure in the space. Granted, I am also long RSI, so I do have exposure to the books as well. But I think getting exposure to data provision, you always hear that moniker like, oh, data is the new gold, or data is the new oil, or whatever. I agree with that general notion, but I think in this space it just really makes sense because it is the type of industry where data is not only fundamentally important to being able to place bets in a timely fashion and have odds updated in a timely fashion, et cetera, et cetera, et cetera. But it's a space where most of the leagues are requiring, and this isn't just the NFL, the NBA does this as well. Most of the leagues are requiring official partners to use official data, which makes sense when you hear it, but it has a really material impact on the prospects for the data providers. So yeah, and this is another space I'm really bullish on. I mean, I could talk about it all day. I don't want to talk about it for like 2 hours, but yeah, I mean, I'm really bullish on sports betting, especially online sports betting. I think the overall sector is going to grow exponentially. I think there's tailwinds, not only in terms of potential legalizations, which will increase the runway, but I think, this space is going to evolve, like I said, from a customer acquisition war to a consolidation war. And then after that point, all of these businesses, I think, will be re-rated at much higher multiples purely because of the growth of this sector alone. And, I expect it to grow not only in participation, but net gaming revenue across all American leagues. And then also on the data side as well, I think these companies are in a great position.
Dude, you kind of hit on the point a little bit, maybe danced around it a little bit. But what I've noticed, maybe you can correct me if I'm wrong, it seems like the stocks that are in your and companies that are in your long-term portfolio are picks and shovels, the stuff that goes into the stuff for
The stuff behind the stuff, yeah.
the stuff behind the stuff for sectors that you're really bullish on. Last one was, EV and rare materials being the picks and shovels for the EVs. I even think to Bitcoin miners and Bitcoin, maybe even semiconductors in that area as well. Is that kind of, you think, it's hard to say the best, but or one of the best ways to kind of invest in these very innovative categories where, it's so hard to pick a winner. I mean, another way a long-term investor maybe could think about it is buying an ETF and kind of just getting the whole bunch and having the full exposure to the sector. How do you feel about that compared to like the picks and shovels play of it?
Yeah, I mean, there's different risk profiles, right? Like when I'm trading, I'm typically trading the companies that deal in the core products because they tend to get the most volume, the most attention, the most coverage, the most news, and so they tend to be more tradable, the companies with the core products. So when you're talking about EVs, you're talking about the OEMs. When you're talking about sports books, like we just discussed, you're talking about the big names like DraftKings, Penn. Those are the names I like to trade. I like to trade the core product names. But when I'm investing, I do prefer the alternate exposures, generally speaking. Now, granted, I'm invested in Tesla as well. I have been for a long time, as I've said before. But, for the most part, my more recent initiations in the EV space have been the lithium plays because I really feel like, that's an industry that's going to benefit indirectly from the growth. Well, not even indirectly, directly from the growth of electric vehicles. But they also have their own kind of equation that's going to drive growth in that sector, which, like I discussed last time, the supply deficit that's expected to last till 2030, the fact that the resource itself is abundant, but the infrastructure isn't there. Like I try to look for these kind of sector-based equations where in my head, in the long term, the way that plays out ends up in value and growth for the sector. And so, yeah, when I'm investing, I do actually prefer, the thing behind the thing, because it tends to be overlooked. They tend to get lower multiples, at least initially. It just feel like it gives you a better entry. And then once the market catches on, those are the stocks that fly, right? Like, I mean, it's precisely what happened with lithium stocks in 2020. Everyone was chasing the electric vehicle OEMs for most of 2020. And then at the end of the year, people were like, oh shit, you need lithium for every single battery. And then people started buying lithium stocks like crazy. And so I think data is going to be kind of a similar realization in the sports betting space. I think a lot of people, when they look at these kind of investments, they think, okay, but like I'm bullish on sports betting. Why would I, invest in a data provider? And I don't think the connection is immediately there. Maybe for people who aren't as versed on the industry or who don't really understand the nuances of the industry, it might not be immediately obvious, like how you like winner agnostically is the word. Sorry, a phrase I was looking for. That these players will benefit, right? Because I mean, you use that term. I use that term a few times, and I understand people might not understand what that means. What that essentially means is the business benefits and grows in line with the growth of the sector overall, and is less dependent on who becomes the primary player or the winner, quote unquote, of that sector and the core as far as core products go. So yeah, I mean, I think more and more people, tend to realize these things later and later into the trend, which to me, I prefer, because then I have a period where I can accumulate those types of names kind of under the radar, and then they get coverage picked up by more and more banks. And then, eventually you see the big money move into those names. But yeah, when it comes to sports betting, I really like the data side. When it comes to EVs, I really like the rare metals side. When it comes to space and satellites, I really like the infrastructure side. So, there's always an alternate exposure to whichever industry that you want to gain exposure to. And I really encourage, investors and traders to think that way, from the perspective of like finding an industry that you believe in or an industry that you're bullish on, in terms of growth, because typically companies don't grow in a vacuum. And I mean, there are exceptions to that, right? There are first movers that often, can do that and then eventually draw other competitors to the space. But barring those exceptions, for the most part, you know, companies that grow exponentially grow because their sector overall also grows exponentially, and they happen to have a moat, a technological advantage, a market share advantage, something in that space that allows them to grow with the sector. And so, when you're looking at alternative exposures and you can find, an industry that you are very bullish on over the medium to long term, and you think to yourself, all right, I want to be exposed, don't immediately pigeonhole yourself to the core product. So, in the sports betting space, the core product would be the sports books themselves. In the electric vehicle space, the core product would be the OEMs, right? The original equipment manufacturers, the people who make cars. So, that's where the most investors' attention goes to. That's where most of Wall Street's attention goes to, is the core products, because it's the obvious play. But I can't think of a single industry where there isn't an alternative exposure to the core product. And a lot of the times they tend to be the better buys. They tend to trade at the better multiples. In certain industries, they tend to be the more profitable names also. And, depending on the industry you're dealing with, depending on the technology involved in the different aspects of the industry, maybe they won't trade at as high of multiples, but it doesn't make them it doesn't not make them growth plays. If you believe that the industry is growing, then the pick and shovel plays will grow with it, as long as they benefit from the overall growth of the industry. And things like rare metals and data providers do benefit, regardless of who wins, like I said earlier. So, yeah, I mean, I'm a huge fan of the pick and shovel plays. And I think that, understanding the multiple exposure thesis and understanding that whatever sector you're bullish on, there's multiple different ways to get exposure. I think that's a really important thing that a lot of people overlook.
Love it, dude. I appreciate that stock talk. I love your thesis on that. Always love hearing you talk long-term investing. And I want to definitely keep this. First of all, actually, let me definitely say, make sure you're following Stock Talk. I'll say it one more time, follow everyone else, but make sure you're following Stock Talk. We just got some great knowledge, some wealth drop there. Now, I do want to throw it over to Wolf and give. I think I said this last time. You should be up here as a co-host. I'm actually going to do it this time. I apologize. My co-host up here, and see if he has anything he wanted to add on long-term investing. Quickly, though, I am seeing a news story that just broke with Peloton that they are pausing their, production of bikes and treadmills, and the stock is getting destroyed again. So once after we kind of go with Wolf and gets his thoughts, I do have a question on Peloton. But yeah, Wolf, anything you wanted to add into long-term investing? If you had a stock or sector or anything, you're kind of starting to get into as well, I would love to hear that.
Sure. Yeah. I mean, I'm not going to go into a deep dive on a specific stock right now, but I will say I definitely still have my long-term portfolio. A couple of those that are in place. I have my more growth-styled one where I'm holding, my Tesla, my SE, my Square, AMD, Palantir, Celsius, things along those lines. And then I do have a Roth IRA as well. I've got stuff like Walmart, Amazon, others in there. So I do have both of those. Not going to go into super long bull case on any of that. You are correct that I have been trading. Not a ton over the past 2 weeks. I've been hanging out with a lot of people from Twitter, traveling, been sick a little bit, been doing a ton of spaces. So just really haven't had the opportunity necessarily to sit down and get a good grasp. And, I've learned from past experiences with trading that you just kind of have to be in that zone. If it's not your focus and you're just trying to do it, casual, offhandedly, like I'm going to throw in a trade here and then I'm not going to pay attention to it for an hour and then come back, you're just going to lose money. For me, it's got to be something where I can sit down and really focus on it. So right now, I've definitely been that default to long-term investing. But yeah, liking some of, the multiples that we're getting on some of these names. I did, several spaces this week where I had the chance to, like we're doing here, ask different investors about some of the names that they perhaps are liking on, per se discount that we are seeing here. And some of these names have come down. So I know that you've been adding to a couple of them, Amazon and others. And so I'm kind of looking to perhaps start doing the same. I didn't really add for several weeks. I wasn't trying to catch something, but now I think, growth has taken a large haircut. If anybody is reading my weekly newsletter, you'll see some good stuff coming out in that tomorrow about just kind of this point in history. I attached a couple of graphs in there, some stuff from Mayhem for Markets and Joseph Fahmy, kind of pointing out just where we are in relation to previous bull markets, bear markets, things along those lines. There's definitely some statistics that do stand out that I am liking. So yeah, I may start adding some more to position soon, but for right now, mostly riding the longs. Was live with exclusive this morning. The only real trade that I liked at that point was American Airlines this morning, and it went, from down 2.5% to currently being up 0.38%. So that one did have a nice move. So I'm certainly still watching the tape, looking for, I do have a couple services that alert me when it comes to, call flow and things like that. But I mean, we're kind of still seeing more of the same right now, with people still adding to a lot of those, long-term investments that you'll kind of see, like the just to put it like the large cap, where those areas of safety per se, and still withdrawing from things like a Peloton or like some of these others that are just continuing to crash. So I'm not trying to catch any bottoms or get into anything dangerous right here. But really appreciated the insight on a space like this, where we heard from Stock Talk and Brad about two stocks that I do own. And it's always nice when you're owning that stock and maybe, it's taken a recent downturn, when you hear those really thorough, bull cases in this instance, and that gives you some nice peace of mind. So I like it. I'm enjoying this, and I'll turn it back to you.
Awesome, man. I appreciate that. Actually, I'm going to turn it right back to you. I do think this is a good point. You do so many spaces. I'm a part of pretty much all of them from the Stock Market News account. Bullish Rippers, we're doing a bunch of spaces. You're hosting a bunch of them. I said a bunch way too many times. I wish I could strike that from whatever, but we're going to keep it going. How do we find all those spaces? Do you have some tool for that?
Okay, Gurg. All right. See you. Yeah. In fact, we do have actually a really, really good tool for anybody that's trying to find when all the best spaces are on FinTwit. So as Evan just mentioned, we're sure many of you have busy lives that don't involve spending your full days on Twitter. Some of you may have day jobs, things along those lines, might like to go out the occasional evening. So how can you know when a space is going to be happening, and how can you know who's speaking on it, what topic it's going to be? Because Twitter Spaces certainly doesn't give us the tools for that, right? They only let us schedule one space at a time. And it's just either going to show up at the top of your timeline whenever you'll see a post, right? Most people don't even schedule them out. So what we've gone ahead, myself and Stock Talk and Stock Market News, and a couple of others I feel like are kind of, getting in on it now, is we've gone ahead and collaborated and built out a full-fledged Google Calendar. This is a free tool. that anybody can use to find all of our spaces essentially towards the beginning of the week and constantly throughout. I will update this and I will add every single space that we are doing. I will add the speakers to it, what the topic will be, what time it will be at. And even retroactively, once it's done, I will go in and I'll take the recording link. As you can see, this is being recorded, and I'll throw that into the Google Calendar. So it's this all-in-one tool for discovering and knowing when spaces will be, getting notified of that, as well as finding recordings. And the simplest way to get onto this thing is right now, if you click onto my profile, you'll see my DMs are open, as well as if you click on a Stock Market News, the account you see up here with the bull and the bear, their DMs are open. All you have to do is send over your Gmail. I mean, that is literally it. If you don't have a Gmail, you could send over another email, but it works best with Gmail. We have 3,000 plus. I feel like we're coming up on maybe 3,200 investors that are on this calendar now. So clearly when you have 3,000 plus people doing something, you can tell it's working. We have hedge fund managers, CEOs, entrepreneurs, people with millions of followers. In fact, even Twitter Spaces employees themselves have DM me and asked me on this calendar. So we love this tool. It makes my life much easier because I know, when I need to tune into a space. It makes a lot of people's lives easier. So if you're not already on it, again, it's free to try out. If you want to unsubscribe from it at any time, it doesn't even send us a message, so no harm, no foul. But we think you'll love it. So feel free to go ahead and shoot over a DM now, and I'll get you on there today.
100% echo that. That was actually a fantastic pitch for the Google Spaces calendar. You can also DM this account, the Bullish Rippers account. Send us your Gmail, and we will get you on that equally as fast, maybe faster. So Peloton is continuing to get destroyed. It's now halted down 24.5%. So to kind of make this into terms and something that we can more use for long-term investors for the future, I want to throw it over to you, Brad, quickly for this. How do you deal with a stock that is just getting pummeled? Yeah, I should have chosen a different word. We're struggling here. We're having some problems. But yeah, how do you deal with a company that has been struggling and been going down so much recently? For anyone who's a long-term investor to it, my first place to go and look is that it IPO'd in the last 2 years, and I probably wouldn't have been interested in from the start. But yeah, how do you kind of deal with this type of situation? Is it kind of strictly just looking into the company and seeing if anything changed, or is it kind of sometimes this price kind of get into you as well?
Yeah, so I don't own Peloton, but I do own a Teladoc, and I do own some of these other companies that have had similar stock downtrends. So certainly not going to rip on Peloton. I don't know much about the company or own it. I do have a bike, so I guess I'm an expert in that fashion. But I'll say there are two different scenarios in which a stock can decline, or not two different scenarios, but two main themes of maybe getting swept up by some external factor and indiscriminate selling, and it's not really fundamentally related. Maybe it's macro related, maybe it's something regulatory, maybe it's supply chains, maybe it's something else, or you get stock price declines that are met with or that coincide with an announcement we get today where they're halting production because, and I quote, demand is waning. And then a couple of weeks ago, it was something about cutting a large portion of their sales and marketing staff. So the one thing I'll say is that this is the argument against buy and hold, and the argument for buy and continuously verify, and have that goal of having a long-term time horizon, but don't have that assumption that you're going to be able to hold it for a long time. Continue monitoring how the company is doing, how it's succeeding, how demand is performing, how margins are expanding, all of those wonderful things. Instead of just putting in all the work at the beginning and then kind of checking out. I think it's really important to continue to verify, because it's important to continue to reiterate that this company actually deserves our money and our investment and our time and energy. And announcements like this, I'll just give a kind of another example of a butterfly that I sold a few months ago because of a terrible earnings report and really just counterintuitive and confusing and for lack of a better term, lame excuses on why it happened, both from a profit and a demand perspective. And I sold the company even though the stock were starting to have more compelling forward multiples. Those forward multiples just became a whole lot less certain. So kind of the tying this into a bow, there's a very big difference between a broken stock and a broken company. If the company is thriving and the stock is tanking, I do catch falling knives. I never catch them all at once. I like to catch them in very small increments and basis points of cash at a time, because I am incapable of timing bottoms. But I do like to add in as risk reward gets more favorable when companies are performing. But when we get announcements like this, that just when the company seems to be broken, then a broken stock becomes a little bit more justified, and multiple compression of any kind isn't super favorable, or isn't extremely compelling, I should say. Just because the company isn't doing what it needs to do to profitably compound and to provide the returns that warrant our money. So that was a long way of saying, focus on the company, and if it's not performing, like these announcements today and a few weeks ago kind of hint at, maybe throw up a red flag and do some more digging, or maybe dip like I did with Butterfly.
Dude, love it. Great explanation. One point that you brought up there was kind of basically dollar cost averaging into dips, really slowly, small amounts. Position sizing, trades, everything like that. Dollar cost averaging is 100% going to be a big focus of one of these spaces near time.
So dollar cost averaging kind of is passively adding to companies at like on a set calendar or set time frame, and I'm more so like opportunistically adding when multiples compress. So it's it's definitely kind of a first cousin of dollar cost averaging, but a little bit different, and I probably should say that. But sorry to interrupt, and go ahead.
No, you're good. I'm the exact same way. I used to explain it to my friends, like the X variable in this, for normal dollar cost averaging is time. For me, it's price. So that's how I kind of go about it. I'm the exact same way about it. But I kind of just call it dollar cost averaging. I probably should explain that a little bit more in the future. But yeah, that's definitely going to be a huge focus on a space going forward. Stock Talk. Actually, Stock Talk, did you have any thoughts on that question?
Oh, well, I heard something about dollar cost averaging. Was that what the question was about?
Yeah, before we were kind of talking before that. If you do have any thoughts on that, me and Brad, actually, that's a good pivot. I like that. So me and Brad were kind of talking about our versions of dollar cost averaging, how, the conventional wisdom, or what the actual definition of dollar cost averaging is, buying in at set periods over time. And, there's a lot of great use cases for that. I would specifically think, someone who is just kind of, I'm going to buy ETFs this day each month, and we're going to do that every single year for long-term investing. That's perfect for it. But for someone like us who's kind of trying to be a little bit more active long-term investors and stock picking, we both kind of use price more as our X variable. So I'll buy every 5% lower a small amount. Kind of want to get maybe your thoughts in general on dollar cost averaging for the long-term investor, kind of that concept that we go with. That slight variation.
Yeah, so I mean, it's tricky. I have different opinions on it. I would say that it works best for what you just mentioned, which is passive investing in ETFs. I think, if you're not a stock picker and you plan to just own the S&P 500 or the NASDAQ, which isn't a bad idea if you're, not active and you don't have the ability or the time to commit to pick stocks, because making a mistake, picking stocks takes time. But if you don't have the ability to do that and you're completely passive and you want to just have exposure to the market, I think DCAing into an index, one of the major indexes, is a fine way to invest. But I think it's a lot trickier when you talk about individual stocks, because, DCAing into an individual stock is, by its very virtue, making the implication that you expect that stock to be successful over whatever period you DCA for. I mean, if you're dollar cost averaging for 3 years, I mean, you clearly have a lot of faith in the company. If you're dollar cost averaging for 10 years, you have a fuckload of faith in the company. If you're dollar cost averaging for 15, 20 years, like some people I know have on Apple and other types of stocks, then it's, extreme conviction. But, conviction aside, I think the issue is that the vast majority of businesses don't maintain exponential growth. The vast majority of businesses don't go from $10 billion companies to $500 billion companies. And when I mean vast majority, I mean 90+%, 95+%. So, knowing that, I think it puts a lot of onus on the stock picker to commit to a position when you're talking about an individual stock to be buying it, whether it's on a scheduled basis, whether you buy it on a basis of price, how you mentioned. For me, if I ever add to a position, I rarely average down, but if I ever add to an existing position, it's only if I believe the position has fallen to a very key support level. I never add randomly. I never add arbitrarily if a stock is down. I never add, I don't base it on price or on a time schedule. I purely base it on finding stocks that are sitting at very strong demand zones, the very, coherent technical support, preferably a technical support that is supported by both the near-term chart and the historical supports. Those are the cases where I will add to a position. But, that being said, back to the DCA thing, the issue of doing it with an individual stock is that, it can get dangerous, especially if you're averaging down. So, if you take a position, for example, I had a buddy who got slaughtered doing it this year with Upstart. He bought Upstart early, rode it up to the top, didn't sell any because, he told me all the time, I'm a long-term investor, I love the company, which is fine. But, watch the stock drop from whatever the peak was, I don't know, $400 or whatever it was, all the way down to 100, and bought on the way down. So he effectively compounded his losses, assuming that the stock would rebound, and kept buying and kept buying and kept buying and kept buying. Stock keeps falling, stock keeps falling, stock keeps falling. And he ended up with a devastating bag that pretty much blew up his account. So, that's in a short-term perspective. When you're talking about a long-term perspective, the same thing can effectively happen. And again, I don't want anybody to mistake. When I'm speaking about these things, I'm really just trying to be transparent about the risks of all of these strategies. The issue with DCAing over a long term into a single stock is, the same thing. You're putting more and more money into the play. And especially in the cases where you're averaging down, or the position is red, or it's been even for 6 months or a year, or 2 years, or however long your time horizon is on this investment, you could end up spelling a demise for yourself, because if the growth of that company falls off, if their moat is compromised, if the theme drifts away, I mean, look what's happened to all of these stay-at-home stocks. Look at DocuSign, Zoom, Peloton today. I mean, naturally, Peloton today was based off a catalyst, but granted, even without the drop today, it's off massively from the highs. Look at all these stay-at-home stocks. A lot of people had a lot of faith in them last year. Go back to end of 2020. Early 2021, so many people's narrative on these stocks was, oh, the habits from COVID are sticky. These are great companies. They've showed exponential growth, et cetera, et cetera, et cetera. All fair points, but in how long of a time period? And that's really where the crux of the question becomes. And that's why so many people get slaughtered, is because it's confirmation bias of believing that, a high growth, high tech company is going to just continue to be that way purely because of the execution they've had in the last 3, 4, 5 quarters. That's a big leap to make, and that's a big, bold assumption to make, that a young growth company will just automatically and assumptively continue to execute on that over and over and over again. And if you're wrong and the growth drops off and the company's competitive moats are invaded, potentially the competitive landscape changes, potentially the relevance of the industry to the market changes, like we've seen with these stay-at-home stocks. Any of those things happening can absolutely destroy your thesis. And as an investor, who in most cases, if you're somebody who's dollar cost averaging, in most cases you're not using a stop loss. And so you're not using a stop loss, you're dollar cost averaging into a loser. And then, years down the road, you end up with this massive, irreparable bag that compromises your ability not only to invest in other opportunities, but can really hurt your confidence. I've seen people quit investing because of, really high conviction picks they had, that they just kept buying and buying and buying over years, and ended up with, 10 to 15% of their initial position. So I think I am an advocate of DCAing if you're a passive investor who doesn't have the ability to stock pick well, or doesn't have the time to stock pick well, and you're purely buying index funds. yeah, that's fine. I think doing that on a monthly basis or doing that based on every correction or based on price action or however you want to do it is fine. But I think with individual stocks, it's really a case by case basis. I'm not saying it's never okay with individual stocks. I'm not saying it's always okay with individual stocks. I'm just saying it's really case by case because it can absolutely blow up your account if you dollar cost average into the wrong name. And it's quite easy to do that, especially if you're a growth and tech investor.
Awesome, man. I appreciate that. It's definitely a DCA, and I would love to explore that topic more. Kind of, I think me, you, Brad, I think we got good diversifying opinions. Well, me and Brad are probably more similar, but I think having that good debate on there could be really great for long-term investors. But I also think another point you kind of brought in there, danced around a little bit. Selling is a really hard thing to do in long-term investing, and taking profits. I see so many people afraid to take a profit because they're up 5x on a position, but what happens if it 10x's? There's always those type of people out there. My thing that I love to do personally, I love to take out my initial investment whenever I have a nice significant gain. But we'll dig more into. So I'm always playing with the house of money. Sorry, but we'll dig more of that into the future. We are going to be heading into wrap ups right about here, but I do see we got Gurg up here. I know you're much more of a trader, but I know you got a nice long term investing hat on you as well, Gurg. Do you have any thoughts or kind of in general on the long-term investing topic?
I think long term, for most people, your best bet is just buying index funds. Most people can't pick good stocks, right, over long periods of time. In the short term, you might make good money. You might make 30, 40, 50% in a year. But in the longer periods of time, almost none of these funds can beat the S&P 500. So I think for most people, just buying SPY or VOO is the best option.
I definitely do agree. The answer is we are in a slightly different place. I get that on Twitter where the people tend to want to explore more and be that person who works more and maybe pick individual stocks. But the answer is like the average investor as a whole, the best thing for you to do is this dollar cost averaging into ETFs.
Yeah, I mean, right, with the SPY, it's almost impossible to time the bottom. So you might be better off buying every single day or every single month a fixed amount, right? Average in. Because you might go all in right now and SPY might drop 30% in the next year. But if you're buying every single month, you will have a better price, right, overall.
100%. I do definitely agree, Gerg. Appreciate you coming up. Appreciate you joining. I would love if you do have any more thoughts in general for maybe that long-term investor that wants to put in that extra bit of work to try and beat the indexes. Or actually, can I actually switch up my question for you? I would
No.
love to kind of. There are
Yeah,
so many
go on.
traders out there who kind of just will be like, "Oh, I'm making so much money here. I'm just gonna keep trading, throw all my money into my trading account, everything like that." Do you think it's important for those type of traders to have a long-term investing account as well, whether it's DCAing into ETFs over time?
Yeah, I think everyone should have a retirement account, no matter how much money you have. Because the amount of tax benefits you get, you can't get them anywhere else, right? Even if it's like 40,000 a year, even if 20,000 a year, your gains on that is not taxed. Why not take advantage of that? So I think everyone should have a long-term account, right? But even if you're trading and you're very, very good at trading, at one point you will have so much money that you can't put all of that in a trade, right? You can't get in without moving the price. So at that point, I would open a new long-term account too, right?
Awesome, man. I appreciate that. One day we'll all be aspiring to get the Gerg amount of trading money and just move stocks like Apple or something like that.
One thing
Yeah.
I want to say on that,
Yes,
Evan. One thing I wanted to say on that really quickly, just is, the same way that I think every trader should have an investing account, I think every investor should have a trading account also, because the comment I get a lot from people when I talk about this is people bring up my Tesla position and they say, you wouldn't have gotten those gains if you didn't invest in Tesla in 2016 and hold it, right? The reality is I made as much, if not more money trading Tesla along the way as I did investing in it. So there's, it's not hard. I think people just view it as kind of incompatible. It's not hard to be an investor, to have a core position and to have a peripheral position around your core position that you can trade with. Like if you're an investor, and we talked about this earlier about how hard it is to sell as an investor. if you're an investor and your stock has a plus 30% day, a lot of investors are like, God, I want to sell some, right? But the people who are dollar cost averaging in every year or every month or, whatever they are, and they're not looking to sell, if you had a peripheral position, you could sell it on that plus 30% day and buy your peripheral position back on the next big red day. And being able to trade a peripheral position while investing in a core position can actually compound your profits significantly more. And you can use the profits from trading your peripheral position, if you're really, really bullish on the stock, to just buy more of the stock. So, it's something that I know I talk about this a lot and kind of repetitively, but it's something that's really always dumbfounded me why traders don't have investing accounts and why investors don't have trading accounts. I just don't understand it, because the market is by its very nature volatile. It goes up, it goes down, and not being able to benefit from the volatility, I think, is an error. So, I just wanted to bring that up because you mentioned earlier, hey, traders can have investing accounts. I think investors can have trading accounts as well. I do both, and I would never go back. I started off as an investor, graduated to being just a trader, went back to some investing, and then quickly realized, you know what? I want to have my long-term compounders. I want to have my long-term winners, but I also want to benefit off the day-to-day volatility of the market, because most investors I know who are young, who are my age or a little older or a little younger, are looking at the market every day. They're looking at their portfolio every day. They're keeping up with the market. If you're taking the effort to do that, how much more effort is it to click a couple buttons every once in a while? So, I don't think it takes this massive burden on yourself of saying, I can't predict short-term price action. That's another, excuse I see and hear all the time. I can't predict short-term price action. That's why I don't trade. Well, not all of trading is prediction. There's selling covered calls. There is, trading options based on an obvious news catalyst. There is building a peripheral position and just waiting for relative strength, selling into it, then buying the peripheral position back on relative weakness. These are reactive moves, not predictive moves. And so, I don't know. I can talk about this for hours. I know we're trying to wrap up, but yeah, if you're a trader in the audience and you've never invested, I encourage you to explore it. And if you're an investor in the audience and you've never traded, I encourage you to explore it, because the volatility in the market is what generates returns in a short order. And so, if you want to be profitable, if you want to look at your portfolio in 10 years and say, I beat the market every year for 10 years, the best way to do that is to do both, in my opinion.
No, I do definitely agree. And there are a lot of aspects of trading that long-term investors really can use a lot. So I'll kind of use that to get us into the wrap-ups and start us there and throw a kind of a question back to you, Stock Talk, and then you can kind of do whatever you got, anything you got going on. Would love to hear maybe a little bit about the Discord as well. But damn, I lost the train of thought on the question, Stock Talk. But I'll just throw it over to you for the wrap-ups, and if I remember it as you're going, I'll throw the question in there at the end as well.
Yeah, I mean, wrap up's kind of what I just said, and just continue to be nimble. I was very stubborn with my trading and investing style when I first started, and adapting it and fine tuning it has been, a blessing, and has really made me more able to trade in any market, whether it's going up or down or sideways. I've found that I'm capable of doing that now because of me adding that flexibility to my repertoire. But just be careful on any strategy you're using, and don't fall into the notion that because something has worked for you X number of times that it will continue to work for you. One of the greatest fallacies, I think, in both trading and investing is that patience pays. It often does. And the famous Warren Buffett quote that everybody resorts to is that the market is a tool for transferring money from the impatient to the patient. And whereas that might be true for a lot of cases, when you think of your blockbusters, like, for Warren Buffett, Coca-Cola, and then when you think of stocks like Apple and Amazon and, these types of stocks, of course, there are great, amazing long-term compounders and winners, and there are great short-term winners as well. But, the notion that if you're a trader holding a bag, or if you're an investor waiting on a position to finally make its big move, whatever it is, I mean, this applies to both. Don't be convinced that being patient is a better decision than prioritizing opportunity cost. So I'll say that again. Don't convince yourself that being patient is a better decision than prioritizing opportunity cost, because in the market, especially, time is money. And
Did he leave?
Yeah, I was I was afraid to cut in there, and if it's
Yeah,
me,
me too. I
but
was like, might
he
be
did
my
cut out.
network, but the chat, yeah, he wasn't speaking, I think.
Well, listen, honestly, Stock
can
Talk,
you hear
you
me?
back there? I saw kind of a mute on mute. Yeah, we hear you now.
Oh, sorry, my mic cut out. Yeah, I mean, if you're a person that's convinced that patience is the solution to your problems, or is the solution to your profit and loss statement on your account, I think you could be in for a surprise, because being patient can backfire on you the same way that it can help you, because stocks can keep going down and trends can keep changing and rotations can keep happening, and you can continue to tell yourself, as your bag gets bigger and bigger and bigger, that you're a long-term investor, or that you're being patient if you're a trader and you're waiting for the bag to bounce, you're waiting for the catalyst to come, but you may end up waiting forever. And I only say this because I've done it personally, and in my early years I held huge bags and took huge losses because of psychological mistakes like this, and I've seen friends absolutely quit trading and investing over those same types of convictions. Like, conviction goes both ways. It can really aid you in finding a great compounder and a great winner, and it can really hurt you in having this false sense of ego or belief, or not being able or ready to admit that you're wrong, which in my opinion, admitting that you're wrong or when you're wrong is one of the most important aspects of investing or trading, because it allows you to move on from a decision rather than clinging to it and buying more of it, or averaging down, or perpetually and patiently holding this bag, which is how people blow up accounts, to be frank. So yeah, I would just say be patient, add skills to your repertoire. If you're an investor, learn how to fucking trade. If you're a trader, learn how to fucking invest. And I really don't think there's a way around it, because most people, the reason 90% of traders underperform the market is because they do one or the other, and that's frankly the rationale. They either do one or the other, or they only play one side of the court. They only play the long side. They never play the short side. And with investors, and since this is a long-term investing space, I mostly should be speaking to investors. With investors, that is probably where the most bull bias is. Most of the long and bull bias I see on Twitter is from investors, because investors are of this belief that the only way to invest is to buy a company and hold it. And they don't even think about playing downside. The same way, if you're a truly skilled fundamental analyst, then you should be able to apply those tools of fundamental analysis to find out when a company isn't worth what it's showing up as. And you should be able to play puts, and you should be able to play the downside as well. So, learn both sides of the ball, learn both styles, both trading and investing. And also, don't fall into these psychological mistakes that believing that patience and holding and hoping will save you, because in the vast majority of cases, actually, it'll go against you rather than for you, because the chances that you pick 10 out of 10 winners is very low, and when you think about the losers, if you're treating them all the same way and you're dollar cost averaging into every single play, then your losers will get bigger and bigger as well. So something to keep in mind, I think something to be cognizant of, and just some few points I wanted to make. For those of you who haven't checked out my Discord, link is in the bio. We're having a great time in there. Lucid puts today did not work out, unfortunately, but I've rolled some over into February, so we'll see if we get any downside in that name next week. But yeah, appreciate that, Evan.
Appreciate you, Stock Talk. First, as we're heading to wrap ups, I do just want to say one more time. I know I've said it a bunch. Make sure you're following all the speakers that we have up here. Click into their profiles, give them a follow. Not all their tweets are going to be about long-term investing. Brad's, I think, mostly will. So, Brad, if you're solely a long-term investor, definitely check out Brad. I'll be going to him in a second. But yeah, make sure you're following all these people. They have amazing content. They really know what they're talking about. And, when they get the ability to think about what they're going to say and really, get the chance to write it down and tweet it out, it's just going to be that much better. So click into all their profiles, give them a follow. The real truth of it, I've been saying this a bunch. The truth of it is you can hit that unfollow button so easily, but you won't want to. But it is there. I apologize for me forgetting the question earlier. I was trying to do two things at once. I was getting a news story out. Twitter is now going to let Twitter Blue users include NFTs as their picture, but like, couldn't you already do that? Right click save. Apparently, the difference is going to be like verified that it's the actual NFT. So I saw that launching today, but that is not the topic of the spaces. The question that I did want to ask you, Stock Talk, but we'll kind of save it for future spaces actually, is about how long-term investors can use technical analysis and can use looking at charts to really enhance their long-term investing game.
I would
But
love to talk about that, yeah, on a future space.
100%, dude. That's going to be a good focus of it. And I think that, kind of title 4 is aspects that long-term investors can use from trading. I think there's definitely going to be a couple other things in there as well. But I would love to keep us moving in these wrap-ups and throw it over to Brad.
Yeah, I'll just say I definitely skew long-term investor and very long-term time horizon, but I also very much so advocate for that active way of doing things, not a just buy and accumulate, but a buy and continuously monitor performance and growth and profitability and optionality and management, use of capital to guide which companies really deserve that long-term time horizon that I'm really that really I use as a goal, as an idealistic goal for my companies, where a lot of them don't end up deserving that goal. So the other thing that I'll mention is that I think that could lead some to maybe fear failure and fear being wrong a little bit, and fear the bad picks, which I think are inevitable and which have been inevitable for me and everyone else who I've seen on Twitter and in other investment spheres. But the really important thing to note is that stock declines stop at 100%. So if you have a strict rule for limiting position size and allocation and how much money you're willing to lose on a certain position, and your losses stop at 100%, you don't really need to bat 1,000, to be 10 for 10. You don't need to be anywhere near close to that in order to do really well, because while losses stop at 100%, gains don't stop at 100%. So the winners that you end up picking within your portfolio, which will prove themselves worthy of your capital again through their consistent performance, not just through one quick check of the company and then buying shares and then holding on and assuming. But that can really take care of so many losers in the portfolio, to really make it so that you need to bat 200 or 300 in order to be successful, not anywhere near perfection. So embrace failure, learn from failure. It's how I learn to refine my process the most, through the shitty picks that I've made in the past. I think it's just important to not expect perfection, but to be really candid with yourself on how to improve your process and to go forward in the framework of long-term investing that I stick to.
Love that, Brad. That was such a great summary of it. And honestly, a great pitch to click in and follow your account if you're a long-term investor. Brad, Stock Talk, going to be on every single one of these spaces going forward. Maybe they'll miss one or two in there. We're not going to, hit them if they don't come or anything. But yeah, the intentions are for them to be on this every single week going forward, talking about long-term investors. And we're excited to keep doing this, and you should check every single one of them out. But I would love to keep the wrap-ups moving now and throw it over to Gurg.
Yo, what's up? So for me, I think whatever makes me the most money, I'll move to that. It might be day trading, swing trading, or long-term investing. So I would look at the situation, right? And if you like a company long-term, I think someone said, right, what would you do if the stock you like and the stock you own keeps on going down? You could do two things. If you had the proper thesis going in, if you did the proper modeling of the company, if you had your own price target, if everything with the company is same, I would buy more. But if you just hopped in because of FOMO, because everyone's going in, I would reassess. If I don't like it, I would cut the bag, right? 20% loss is still better than 50% loss. So, and the stock, you saw, right, last 6 months, almost all of these no revenue growth names are being hammered down. The Goldman no revenue tech index is down 55% in the last year. So know what you own. If you know what you own, if you're still bullish, I would buy the dip, right? Because you might know something that the market is not realizing. So have conviction with your place and stick with your thesis. That's the most important thing, I think.
Honestly, a point you brought up there, that I really want to jump on, and then I'll keep us moving over to Gav, is there are these different ways to long-term invest in different type of companies you can long-term invest in. There's the AT&Ts, the Verizons, the whatevers of the world, the high dividend, the
I
stock your
hope
grandpa might be buying.
AT&T is not on the list for long-term investments for people.
Yeah, maybe for your grandpa who just needs that dividend income for the next 5 to 10 years, or that small piece of the portfolio. But what I really want to get at is that if you're buying a no revenue company that has this long term thesis you see, that still is a very risky play. Getting a company from no revenue to profitability to huge company. Like there's 1 in 100, 1 in 1,000. I don't even know the number, but it's super difficult. And the point I'm getting
Yeah,
at is
maybe in
positions have to be
SPACs,
these
right? I would
positions have
say
to be
90% of SPACs, they won't be here in the next 5-10 years. Because the valuations that go public are just insane, right? I think most of them will either file for bankruptcy, B, be acquired, or 3, be striped off and get delisted. So, like he said,
yeah.
I think the main metric people should look at is the free cash flow per share. Or you could one more metric I love to look at is the free cash flow, right, for the share. Even if you look at Amazon and if you look at the Amazon shareholder letters, the main thing they have been focusing on for the last 20 years has been free cash flow per share. Because if they have that, if the company has that, they can do anything. They can pay off the loans, they can pay dividends, they can buy more assets too, right? I think free cash flow of a company is the most important thing for long-term investing. That's the first thing I look at for a company if I want to buy it for long-term. Free cash flow per share.
Appreciate that, Gerg. Just finishing the point that I was making as well. Just when you're taking those high risk, no revenue companies, they should be positioned correct in your portfolio. You can make a bunch of really big bets as small pieces of your portfolio. Just know that the risk you're taking on should definitely come into thought when you're sizing the position in your portfolio. A super risky name should not be your largest holding. Uh, that's just kind of the way it normally goes. Not financial advice. You could do whatever you want, but I think when you look over time, that's definitely not the way to long-term invest. But I don't want to just throw over blanket statements. We'll dig into that and more in the future on other spaces with Brad and Stock Talk. But I want to throw it over to our last speaker, but certainly not the least speaker, my amazing co-host here who does nonstop spaces all day, every day. Wolf, love to hear your wrap up and maybe anything else you got going on.
Well, I just went ahead and NFT'd my profile picture so that I can set it as my profile picture as an NFT. For whatever that does. Apparently it's a hexagon shape instead of a circle. Ooh, thanks, Twitter Blue. On another note, if these are the groundbreaking Twitter features, these Twitter puts can keep paying. With that being said, I really did enjoy this. It was great getting insight into long-term perspectives on both SoFi as well as GENI. Those were really, really good. I think we talked through a lot of different opportunities. I like the discussion on whether you should just have the trading account, the investment account, the retirement account. I think that's what we're all coming to these spaces for.
Yeah, Wolf.
Oh boy.
How so many spaces in the last half a minute? You mentioned 5 spaces. How can someone dumb like me keep track of all of them? So, any calendar, any website that I can do that?
There is indeed a calendar, and I did give a full rundown on this a little bit earlier, but for anyone that missed it, the single best tool used by over 3,000 investors on Twitter to find Twitter Spaces is the Twitter Spaces Google Calendar. We should trademark that. With that being said, the easiest way to get on it is just DM right now, either to myself, the host, or to Stock Market News that you see up here. Just shoot us over your Gmail. It's a free Google Calendar, works similar to other Google Calendars you may have been added to. You'll see every single space that we're doing ahead of time. You'll see who's speaking on it, the topic, and then afterwards you can actually check back and find recordings. So many people ask me, like, hey, I missed this space. Where can I find the recording? You're not going to scroll my timeline. I tweet all the time, like scrolling and scrolling and scrolling. Instead, you'll be to be on the calendar. That's the easiest place to find these things. It is just so simple. And again, a free tool that you can subscribe to by just coming into our DMs and simply shooting over a Gmail. That is it. And if you don't like it, you can unsubscribe at any time for free. Gerg, you got any other questions on that, Gerg?
Yeah, I have a question. So the rumor was from Bloomberg to the people, right, who work at Twitter Spaces use that too. any substance to those claims? Are those true or just rumors?
That is very true. Very true. Yeah, multiple people at Twitter Spaces have reached out and asked me to add it onto the calendar, in addition to a total, host of number other reputable accounts. In fact, I even have one of the Twitter Spaces people coming on a space later today. But y'all would know that if you're on the calendar. All right. With that being said, I think that's pretty much everything for me right now. That's it for me, Evan. All you.
Two things before we do wrap it up. First, this was the second spaces in this long-term investing series. The recording of the first one is up above in the nest to the YouTube and Spotify link. It's the first one. I just repinned it up there so you can go in and check it out. And then Wolf, I just want to know, have you put out a reminder link for that spaces yet? Is it like high up in your profile or something like that? Where can they find it?
Yeah, definitely. I have already put out that reminder link. Everyone knows that I've been pretty excited for this one. I can go ahead and pin it right now into the top of this. I put it out 1 hour ago. It is now pinned in the top of this.
All right, perfect. I can confirm I see it. So for anyone in here, I will be on it. Stock Talk will be on it as well. Make sure you hit that set reminder button so you get a notification when Wolf goes live with that one. I'm actually really excited for it. And make sure you're following all the speakers we have up here. Thank you, everyone, for joining in. Thank you to my speakers for coming in and being a part of this. I'm super excited for the spaces going forward. And yeah, make sure you're following the Rippers account, and we will catch you on the next one.